Okay, we've talked about some of these things again, but I want to stress, because definitions are kind of important here. You don't need to know too many whiz-bang things, but tax-free means no tax. And you'll find tax-free investments in things like municipal bonds, muni bonds, and Roth accounts, Roth IRAs, or 401k plans now have a feature in them that allows for Roth investing. And all Roth really means in the retirement account world is you don't get the tax deduction when you make the current contribution, okay? Traditional accounts, you do get a tax deduction. The difference between Roth and traditional tax-deferred accounts, one, you get a deduction going in, and the Roth you don't. But the Roth, as long as you meet two simple tests, that money you pull out of the Roth account grows tax-free. You'll never pay a penny of income tax on that good growth. Tax-deferred means I get a tax deduction today, and it percolates and percolates and grows and grows and bubbles. But when I go and pull money out of that at some point in time, I pay income tax at whatever rate is in effect at that time, and that's the great unknown. We don't know what tax rates are going to be in the year 2020 or 50 or whenever you need it. Okay. Again, tax deferral, even if it's tax deferred and not tax free, in my opinion, I'd much rather pay the government 30 years from now than pay them today. So that's why I make most of my investments out of my 401k plan, and I really focus on that. I want to point out one thing here, this triggered a thought. I do some financial planning for work in North Carolina, and she's got a lot of money, but she's got about $3 billion in muni bonds in her IRA. And so I said, do you know why you own municipal bonds? Because municipal bonds are tax-free and they're state-free if you have a California, anywhere in California municipal bond, you guys don't pay state income tax or federal income tax on that municipal bond interest income. So I asked this woman, I said, why do you own municipal bonds, which are already tax-free? Why do you own those in a retirement account that doesn't pay taxes anyway? And she didn't have an answer, and she said, well, that's where my advisor suggested I own it. I said, well, that's an answer. But she's got a lot of money outside her retirement account in taxable accounts, taxable brokerage accounts. They said, in my opinion, my humble opinion, I think your taxable brokerage account is a better place to own muni bonds. And let's put something in your IRA, like a 12% return, where you're going to get to keep all 12%. And so people don't really think through enough, in my opinion. You've got two pockets. You've got a taxable pocket, which is what you get your payroll into, your savings account, your checking account. That's what you use to live off and pay for pizza and gasoline. But your retirement account, you're not going to usually need that today, hopefully. Hopefully that's deferred long-term savings growth. And that's where you should really focus and concentrate on putting investments that can grow long-term, that have high income tax rates today. Again, like rental real estate, I tell people, go own that little $120,000 home, all cash in your IRA, and you'll get a great cash-on-cash return and never pay a penny of income tax. Okay? Lots of good things. Okay, where are we? Okay, this is a wonderful chart. I'm not going to bore you with it, but I want to point out a couple things. IRAs, again, we talked about authority. This isn't news, or new news. Retirement accounts, IRAs were created in 1974. So this is what, 2011, I almost said 2011. 2011, so that's what, 26 years? I'm not good with math. That was a long time ago, right? My point is, this isn't new. This isn't new. It's not like I'm bringing you a new concept tonight. This has been around a long, long time. Now, IRAs started out, you could only contribute $1,500, and then they've added some amounts, and now you can contribute $5,000 and $6,000, and et cetera. But my point is, this is not a new strategy. So if you're like me, and you're the doubting Thomas, you're probably asking, well, why don't I know about it? We're going to get into that in just a minute. But again, I want people to understand that self-direction, you deciding what goes in your retirement account and what you do that's allowed by law is technically known as self-direction in this industry, but that's not really a defined term. So if you go into Wikipedia, you might hear some comments about this or read some things, but you're not going to see it in a dictionary. As much as I like Fidelity, and I'm not trying to be critical of them, retirement accounts for the most part have to have a custodian. IRAs have to have a custodian, okay? That's Internal Revenue Code rule. Fidelity will be more than happy to be your custodian. So will Bank of America and Merrill Lynch and Morgan Stanley and you name it. They'll be your IRA custodian. The problem is taking title to a condominium on 123 Main Street is difficult for those guys to digest. And that's different from the condo right next door, right? And so they're more than happy to hold your retirement account money as long as you buy commoditized, homogenized products. You know, they're more than happy to own mutual fund, 100 shares of Microsoft, 100 shares of Amazon, Starbucks, you name it, because that stuff they can put on a server and process all day long. Okay, they can't handle a rental piece of real estate or me making a loan to Reggie, because that just sounds, it feels weird to them. And so that's why, and I do this for sheer entertainment, which tells you where I come from, but I go into my Schwab office to test the new guy at the desk, you know, the new 24-year-old who's just been trained. I say, hey, can I buy real estate by IRA? And I either get, it's illegal, you shouldn't do it, we don't recommend it, you can't do it here. I mean, I get a variety of reasons instead of just saying, we're not set up to handle that. So the reality is the law allows it, but a lot of financial institutions operate in a narrower band than what the law allows. And the law allows you to go from here to here, we'll look at that in a second, but these custodians aren't required to offer what's allowed by law, okay? And that's what they don't tell you. They don't give you advice. So you can say, yeah, Fidelity, I'd like to have some stuff with you, but I also want to have some real estate, you know? Because the minute they can't frankly give you investment advice unless it's an investment advisor, but you'll take your money away, and they make money on your money. And so if you leave them, then, you know, they're not going to make money. So it's, America's great, but it doesn't have your financial interest at heart, okay? There are self-directed custodians. There's quite a few of them. Pensco is one of them. There's a variety of them out there that you can use. And they will allow you to take your IRA and buy real estate. So a lot of people end up having their IRAs at two different places. And that's perfectly acceptable. The other thing I want to point out, I think a gentleman asked me earlier, you can have as many retirement accounts, frankly, as you want. You could have 10 IRAs. A lot of people think, well, I'm limited to a retirement plan in my employer. Well, you're not. You can almost always have a 401k there, 403b, 457, and an IRA off to the side. So you can do a lot of things in the retirement world that people don't really know about.